Is it better to take huge risk to earn a few extra percentage points, or to invest in a tax vehicle that helps you keep those same points without the risk? That's the quiet divide shaping markets right now. Retail investors are chasing yield in CCC-rated junk bonds, the riskiest part of the debt market, for a little more income. But the ultra-wealthy? They're not chasing risk at all. They're avoiding taxes, legally, invisibly. This month, CCC bonds gained 0.75%, outperforming all other credit tiers. Retail demand is strong, and confidence is back. Stocks are up, Powell is still at the Fed, and volatility is low, so people are reaching for return. But while they're taking risk, institutional money is engineering outcomes using a tax strategy called the 351 conversion. The Twin Oak Active Opportunities ETF, ticker TSPX, launched in February with $450 million. On the surface, it looked like any other long-term growth fund. But something strange happened. $99 million flowed in, then out, then in again. And during that time, the ETF replaced a huge chunk of its portfolio. Snowflake and Datadog were swapped out for a plain S&P 500 tracker. And all of it happened without realizing capital gains tax. This isn't a loophole, it's legal. It's a tax deferral strategy built into the US tax code under Section 351, originally designed to encourage entrepreneurship. Here's how it works. A high net worth investor has massive unrealized gains in stocks like Nvidia. Selling triggers tax. But if they contribute that stock into a new ETF through a 351 conversion, the ETF can then swap those holdings for new ones via in-kind trades. No sale, no tax, just a reset. As Jack Bogle once said, it's like getting an interest-free loan from the government. While retail investors are trying to make 3% more through high-yield risk, the wealthy are preserving that same 3% by not paying taxes on gains. They get the same reward with less risk and better compounding. That's not just financial arbitrage, it's structural advantage. If you want to see another example of how systems are shifting, check out our video on how Walmart and Amazon are quietly reshaping the financial system with stablecoins. It's part of the same trend. Powerful actors bending the system in their favor, while the average investor takes the exposure. These 351 ETFs are unlabeled. You won't find them advertised, but they're growing, and fast. Some use heartbeat trades, artificial inflows and outflows, to help restructure the portfolio in days. Others, like TSPX, quietly reallocate without ever triggering a taxable event. Meanwhile, retail investors are overexposed to credit risk. CCC bonds default more often, liquidity dries up faster, and ETFs holding junk bonds could be forced to sell under stress. The upside is capped, the downside isn't. The bigger question is policy. Bloomberg reports ETFs distribute just 0.12% in capital gains taxes annually. Mutual funds distribute 2 to 4%. Over time, that adds up. One academic study estimates up to $2.5 trillion in deferred capital gains tax through ETFs over the next decade. So while some Americans are risking principal for yield, others are protecting gains and pushing the tax burden to everyone else. As Villanova professor Rabi Moussaoui put it, who's going to fund the deficit if we don't collect these legitimate sources of revenue? This is the quiet divergence in today's financial system. Risk versus structure. Exposure versus optimization. Retail versus institutional. If you found this valuable, hit like, drop a comment with your thoughts, and subscribe to Global Notes by JP. We break down the macro shifts that actually move markets, beyond the headlines. And if you want to see how digital money fits into this story, don't miss our breakdown on stablecoins and the future of inflation control. It's all connected. Thanks for watching.